This video is going to be taking a look at something very important, as it has come up every single year apart from 1 year, but like the buildings still have in that year that they didn't come up, the buildings are still in the trial balance, so you still need to put them into the fixed assets in the balance sheet, but there was just no adjustments on them. But there's quite a lot of marks going here for buildings. Usually sometimes there can be up to three adjustments relating to buildings. So let's get started and see what we might see. So you can be asked to depreciate buildings for the year. You could be asked to take into account a revaluation reserve, so if the value of building has increased. You could be asked to take into account that VAT has been entered into the buildings account instead of actually going into the VAT account, so you can be asked to fix that. You can be asked to account for a store or something being damaged and then the rebuilding of the store, and then the building of an extension. So there's tons to look at here. So let's start by taking a look. So 2021, question 1A. So during 2020, a storeroom which cost 75, and stock which cost 24 were destroyed by fire. The insurance company has agreed to contribute €90,000 in compensation for the fire damage. No entry has been made in the books in respect of the fire. A new storeroom was built by the business's own employees. The cost of their labour, $44,000, had been treated as a business expense, and the materials costing $38,000 were taken from existing stock. No entry has been made in the books in respect of this new storeroom. And then adjustment 5. Buildings are to be depreciated at the rate of 2% of cost per annum. Land at cost was $400,000, and it was decided to revalue the land and buildings at $1.1 million on the 31st of the 12th, 2020. Okay, so let's take a look. So you've already got the info here from the trial balance. So this is just what I took from the trial balance. The cost was $900,000 and the accumulated depreciation $105. So a storeroom which cost 75 and stock which cost 24 were destroyed by fire. So minus 75 here, minus 24 here. The insurance company has agreed to contribute 90,000. So they've agreed to contribute 90,000. They haven't paid that yet in compensation for the fire damage. No entry been made in the books in respect of the fire. Now, we need to think, when we see an insurance claim, we need to think, does the insurance claim cover the loss? So the loss was 75 plus 24, which is 99. So that means that there's a loss on fire there of €9,000, which is an administration expense. So loss on insurance claim, loss on fire, whatever you want to say, €9,000 there. Part 4. A new storeroom was built by the business's own employees. The cost of their labour, 44, had been treated as a business expense, and the materials costing 38,000 were taken from existing stock. No entry had been made in the books in respect of this new storeroom. Okay, so what this is saying is that the cost of rebuilding the asset is actually in the trading profit and loss, which is completely wrong. All that should go in the trading profit and loss is the revenues and expenses for the actual business during the year. It's not for assets such as a new storeroom. So what we have to do is we have to take the amount, the cost from there. So we have to take the 44,000 out of salaries and general expenses, and we have to take 38,000 away from the purchases because that's the stock, and we need to add it to the asset, buildings. So we take the cost of building the asset out of the trading profit and loss, and we put it into the buildings. Then we look at note number 5. Buildings are to be depreciated at the rate of 2% of cost per annum. Land at cost was €400,000. It was decided to revalue the land and buildings at $1.1 million on the 31st of the 12th, 2020. Okay, so the buildings, right, are now 907 when we add all this up. Okay, 907, but we do not depreciate land, 400,000. So 907 minus 400 land multiplied by 2 is €10,140 depreciation, which we will add to the accumulated depreciation there in the balance sheet. So we've now got 105 plus 10,100. Now it says it was decided to revalue the land and buildings to 1.1 million, right? So the buildings had cost 907, but now they're revaluing them up to 1.1 million. and we've also depreciated them quite a lot. So when we when we revalue building, we're going to have a revaluation reserve down in the finance buy. So it's not like a profit that they've made from revaluing it and the value of it increased. It's not a profit, okay? But it is something of value that they're sitting on, which has to go into the finance buy, which is owed back to the owners. So that's why it's in capital and reserve. So how do we get the 193? The 193 is the difference between the new value, 1.1 million, and the cost, 907, okay? And then we add back in the depreciation, accumulated depreciation from the trial balance, and the depreciation from this year. And that's how we get the 308,140 revaluation reserve. So that's the 2021A done. 2021 question 1B, there was no buildings adjustment. So all you do is you put the factory buildings cost and the accumulated depreciation into the balance sheet. Okay, 2020 exam, note 4. A new warehouse was purchased during the year for, I didn't write it in here properly, for 90,000 plus VAT 13.5%. The amount paid to the vendor was entered in the land and buildings account. No entry was made in the VAT account. And then note 5, buildings are to be depreciated at the rate of 2% per annum on cost. Land and cost was €500,000, and it was decided to revalue the land and buildings at €900,000 on the 31st of the 12th, 2019. Okay, so there was a mistake with the VAT, so it's important for us to have a look at where the VAT is in the trial balance. So we've already put our figures down into our accounts when we were doing step 2, but the VAT here is saying 3,100 on the credit side, so that is a liability. Okay, so that's how that looks when we put our figures from the trial balance in. But let's now look at this. So a new warehouse was purchased during the year for 90,000 plus VAT 13.5%. The amount paid to the vendor was entered in the land and buildings account. No entry was made in the VAT account. Okay, so there was a mistake there. Bookkeeper made a mistake. What should have happened was that 90,000 went into the buildings account, and then the VAT, 12,150, should have went in the same side as the VAT account. Okay, so it would have been entered into the bank account as well on the credit side, but there was no mistake in that, so that's why we're not looking at the bank. Now, what happened by mistake was that the entire amount went into the buildings account, so the 90 and the 12,150 went into the buildings account. So to fix that then, we have to put 12,150 on the credit side of the buildings account and then 12,150 on the debit side of the VAT account. So the buildings are going to look like this. So we're going to minus 12,150 here, and then the VAT we need to debit 12,150. Now this was credit in the VAT account 3150. So if we debit 12,150, we are going to have a current asset in VAT instead. So it'll be the 3,100 minus 12,150 here. And that's that. So now we can do the next adjustment, which is adjustment 5. Buildings are to be depreciated at the rate of 2% per annum on cost. Land at cost was €500,000. It was decided to revalue the land and buildings at 900,000 on the 31st of the 12th, 2019. Okay, so our buildings are actually 975 minus 120, or sorry, 12,150, all right? And then we have to take away the land because we do not depreciate land. So it'll be the 975 minus 12,150 minus the 500,000 land, multiply that by 2%, that is 5,657 depreciation there. Okay, which we will add up in the accumulated depreciation there as well. Now the last sentence says it was decided to revalue the land and buildings to 900,000 at the end of the year. So 900,000 and there'll be no depreciation, and 900,000. So as you know, when we have a reval reserve, when we revalue buildings, we'll have a revaluation reserve down in the finance buy. So where did these three figures come from to make the 147,807? Well, the 117,150 is the difference between the 900,000 and the 975 minus 12150, which is 782,850. So that is 117,150. And then we add back in the accumulated depreciation from the trial balance, and then we add back in the depreciation for this year. and that's 147,807. Right, now we've got the 2019 question, which was a little bit unusual. So you have your 850 here and your accumulated depreciation on the other side. Now this was unusual because it's the first time they did this. The company revalued land and buildings at 975 at the start of the year, so on the 1st of the 1st. So the land element of this new value is 150,000. The revaluation has yet to be included in the accounts. Buildings are to be depreciated at the rate of 2% of cost per annum. Okay, so this is definitely unusual. It was revalued at the start of the year. Okay, so what we'll do is we'll work out, first of all, what's the depreciation charge for the year. So we've got 975 minus your 150 land multiplied by 2% is 16,500 there. Now we add that 16,500 up here, so we've got 16,500, 975 because it was revalued to 975 at the start of the year, minus 16,500 is 958,500. Now what we do then, revaluation reserve, because it was revalued at the start of the year, we don't have this year's depreciation here. You'll see here we usually have 0 up here when it's revalued at the end of the year, and that 1650 would be down here. But when it's revalued at the start of the year, we only have 2 figures. We have the difference between the new value 975 and the cost 850, and we have the accumulated depreciation from the trial balance, and that's it. In 2018 then, there was a bit of work to do here. So this is a manufacturing account and there was a few things going on. So note 5 here, which you see here, we have provide for a recent wage increase of 5% to be backdated to cover the 3 months from the 1st of the 10th, 2017. Then we have note 6, during 2017, January through to December, Austin Limited built an extension to the warehouse. The work was carried out by the company's own employees. The cost of their labour, 24,000 before the wage increase, was included in factory wages. The materials, costing 31,500, were taken from stocks. No entry had been made in the books in respect of this extension. Okay. Then we have in note 8, provide for depreciation as follows. Buildings at 2% of the cost at 31st of the 12th, 2017. And depreciation on buildings is to be allocated 75% to factory and the remainder to office administration. Now you're probably wondering, why has she highlighted the wage increase? What's the crack with that? Well, because they rebuilt a store and it was from January through to December the whole year. The employees built the extension, so the extension will have to account for that wage increase as well. So that's why I have done that. So let's get started here. So provide for a wage increase of 5% to be backdated to cover the 3 months. So the direct factory wages were 200,000, and then we add 2,500 wage increase, so 2,500 there. And then we have creditors, wages due 2,500 here, because provide for, provision to be made for, it hasn't happened yet, it needs to happen, so we have to pay it. That goes into creditors minus 1 year. Okay, then during 2017, January through to December, Austin Limited built an extension to the warehouse. So the work was carried out by the company's own employees. The cost of their labour, 24, was included in factory wages. The materials costing 31,500 were taken from stocks. No entry had been made in the books in respect of this extension. Okay, so basically the costs of doing that were included in the manufacturing account. Okay, so what we have to do is we need to take it out of the manufacturing account because it doesn't belong there. The manufacturing account is basically telling us how much did it cost for us to make X, Y, or Z, okay? The product that we manufacture. So what we have to do is take the costs from here and add them into the buildings, because it's actually an asset that was being added to. It's not something that relates to the cost of manufacture of their goods. Okay, so very, very, very important that we take it out of the manufacturing account and put it where it belongs, in the asset there in the balance sheet. Okay, So the work was carried out by the employee's own wages, the company's own employees. So we need to take out the 24,000 from there. But then I have the minus 300 there. So what do you think the minus 300 might be? Well, it's the wage increase that relates to those 24,000 wages for those employees. So that's what that 300 euro is there. Then we take out 31,000 from the purchase of raw materials. Then we add 24,300 and 31,500 to the buildings where it belongs, because those costs related to the cost of the buildings and it shouldn't be in the manufacturing account. So that is how you do that adjustment. The last adjustment now relating to this, adjustment 8, buildings at 2% of the cost at 31st of the 12th 2017. Depreciation on buildings is to be allocated 75% to factory and the remainder to office admin. So we have depreciation on buildings 995,800 by 2% by 75, 14,937, and so that's 75% of it. And then we put 25% of it into the TPL only because they've asked us to do that. So the remainder to office admin, so that is admin expenses here, 995 by 2% by 75, 4,979. And where will we put the 100% depreciation? So the 100% depreciation, 19,916, needs to be added to the accumulated depreciation here. So we have 995,800 there, then we have 59,916, and then 935,884. So that is that 2018 one done. Quite a lot going on there. Right, so then we have 2017, note 7. Provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 800,000 on the 31st of the 12th, 2016. So a nice and easy one here. This is a sole trader final account. Okay, so these figures here came from my trial balance. This is the cost and this is the accumulated depreciation. So 680 minus 595 is my 85,000 accumulated depreciation so far. So nothing special going on here at all. Buildings depreciation is your 680, all right, multiplied by 2%, so 13,600. There was no land or anything like that in there. We add the 13,600 to the accumulated depreciation bracket here, the second brackets, and then it says we were revaluing our land to revaluing our buildings to 800,000 on the 31st of the 12th. So 800,000 and 0 and 800,000. And then we have our reval reserve. So we have the difference between 800,000 and our cost 680 is 120. And then we add back in the accumulated depreciation from the trial balance. And then we add 13,600 depreciation charge for the year. So in total, we've got 218,600. Okay. Then we have 2016, so note 7. So during 2015, Ryan Limited built an extension to the warehouse. The work was carried out by the company's own employees. The cost of their labour, 12,000, is included in factory wages. The materials costing 28,000 were taken from stocks. No entry had been made in the books in respect of this extension. And note 8. Provide for a recent wage increase of 5%, which has been backdated to cover the 6 months from the 1st of the 7th, 2015. So same applies here as per the 2018 question. The wage increase is going to have an impact on the buildings. So Ryan Limited built an extension, but the cost of the extension is currently sitting in the manufacturing account, which is incorrect because it is not got to do with the production of the goods that the business sells. So we need to take that out of there. And then we need to put it into the balance sheet, into the buildings account. Okay, so we will take 12,000, the cost of the labour, out of there, and we'll take 28,000 out of the purchase of raw materials because that's how much the materials cost. And we'll add those two amounts to the buildings account. So that is note 7 done. Note 8 then, we have to take into account this wage increase. So the wage increase, 220, right, by 5% by 6 over 12 is 55. But then we have to take away the amount of that relates to the building. So 12,000 of the wages relates to the building, 12,000 by 5% by 6 over 12 is 300. So plus 55 minus 300. And we have to add that to the buildings, plus 300 there. But then we also have to provide for. So provision should be made for provide for. That means that it has not happened yet. So we have to put that into creditors, amounts falling due within 1 year. 5 there. Right, 2014 sole trader final account, note number 7. So provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 720,000 on the 31st of the 12th, 2013. Okay, so nothing special going on here either. We put the buildings cost here and we put the accumulated depreciation there. So provide for depreciation on buildings at the rate of 2% of cost per annum. So 640 by 2% is 12,800, which we will add up into the accumulated depreciation. So plus 12,800 there. And then the next sentence, it was decided to revalue to 720 at the end of the year. So 720, 0, 720. And then we're going to have a reval reserve. So it's going to be made up of 3 figures because the reval happened at the end of the year. It's going to be made up of 80,000, which is the difference between 720 and 640. So the new value and the cost. Then we're going to add the accumulated depreciation from the trial balance back to that. And then we're going to add the 12,800 depreciation for the year there too. So they all add up to 187,800. Then 2013, no buildings adjustment. In 2012, a nice easy one. Company account, we just have to depreciate buildings 2% of cost. So buildings at cost 800,000 and there was no accumulated depreciation anywhere. So that's how it's going to look from the trial balance. 2% of cost, 800,000 by 2% is 16,000. Add that to your accumulated depreciation there and we've got 784,000 net book value at the end of the year. So very, very, very easy one there. In 2011, it's another manufacturing account. So it says factory buildings cost 550 and that's the net book value 440. So accumulated depreciation there is 110,000. Note 8, depreciation is provided on fixed assets as follows. Factory buildings at 2% of cost. At the end of 2010, the company revalued the buildings at 650,000. So we have to do our depreciation. So depreciation factory buildings is going to go into factory overheads in the manufacturing account. So 550 by 2% is 11,000. That 11,000 we will add to the accumulated depreciation up in the accumulated depreciation bracket. Then it's revalued to 650,000 at the end of the year. So we're going to have 650, 0, 650. And then because we've revalued the buildings, we're going to have a revaluation reserve. So we're going to have the difference between the new value and the cost, which is 100,000. So 550 and the 650, 100,000. We're going to add back in the accumulated depreciation, which we had from the trial balance. And then we're going to add the depreciation charge for the year. So because it's revalued at the end of the year, we've got 3 items there. Right, the 2010 question, sole trader final account. Buildings cost 620 and then the net book value is 515, so accumulated depreciation there at 105. And then note 7, provide for depreciation on buildings at a rate of 3% of cost per annum. It was decided to revalue the buildings at 850 on the 31st of the 12th, 2009. Okay, so let's have a look. So buildings at the rate of 3% of cost, 620 by 3% is 18,600, which we will add to the accumulated depreciation up here. Then we're told it's going to be revalued at 850 at the end of the year. So we'll have 850, 0, 850. When we revalue, we're always going to have a revaluation reserve. Where do we get these figures from? The 230 is the difference between the new value and the cost, which was 620. So that is 230,000. Then we add back in the accumulated depreciation from the trial balance, and then we add back in the depreciation charge for the year. So overall there, we've got 353,600. 2009. So 2009 manufacturing account. So during 2008, Blenheim Limited built an extension to the warehouse. The work was carried out by the company's own employees. The cost of their labour, $17,000, is included in factory wages. The materials, costing $33,000, were taken from stocks. No entry had been made in the books in respect of this extension. And then note 8, depreciation is provided on fixed assets as follows. Factory buildings at 2% of cost at 31st of the 12th, 2008. At the end of 2008, the company revalued the buildings at €600,000. Okay, so let's get started. So we see this quite a lot in manufacturing accounts. So the cost of the extension is currently in the manufacturing account, which is completely wrong. It should go into the asset building up here. So we take the cost of the labour from the direct factory wages, and we take the cost of the raw materials from the purchase of raw materials here. So minus 33, minus 17. And what we'll do, we'll add those to the cost of the building, which is where they rightfully should go. Because this cost of manufacture should only be how much did it cost for us to make the goods that we sell, not how much did it cost for us to make the goods that we sell and make an extension for ourselves while we're at it. So that's that adjustment done. Then adjustment number 8, depreciation is provided on fixed assets as follows. Factory buildings at 2% of cost. So the cost is 525 plus 17 plus 33. So multiply that by 2%, we get 11,500, which we will add to the accumulated depreciation up here. Then we're told at the end of 2008, the company revalued the buildings at 600,000. So we're going to have 600,000 and then 0 at the end of the year and then 600,000 there. Then, because it's revalued, we're always going to have a revaluation reserve. So it is the difference between, so that's 525 plus 50,000, that's 575. So it's the difference between 600,000 and 575, which is 25,000. So the difference between the new value and the cost. Then we add in the accumulated depreciation from the trial balance, and then we add in the depreciation charge for the year. So we get 81,500 altogether there in the reval reserve. In 2008, we have buildings cost 580 and then 485 here. So the difference there is 95,000 accumulated depreciation. The adjustment says, note 7, provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at €800,000 on the 31st of the 12th, 2007. Okay, so let's take a look at that. So provide for depreciation on buildings, 2% of cost. So 580 by 2% is 11,600. And then it was revalued at the end of the year, 800,000. So 800, there we go. But we added the 11,600 to the accumulated depreciation, as we always do. When we revalue, we're going to have a revaluation reserve. So we're going to have 800,000 minus 580 is 220. So that's the difference between the cost, the new value, and the cost. So 220 there. We add the 95,000 accumulated depreciation, and then we add the depreciation charge for the year. So altogether there, we've got 326,600. And that's us. Now, 2007, so buildings, note 5. So during 2006, a storeroom which cost €40,000 and stock which cost €12,000 were destroyed by fire. A new store was built by the firm's own workers. The cost of their labour, $19,000, had been treated as a business expense, and the materials costing $51,000 were taken from the firm's stocks. The insurance company has agreed to contribute €52,000 in compensation for the fire damage. No adjustment had been made in the books in respect of the new or old store. And then note 7, part E, buildings to be depreciated by 2% of cost. Okay, so let's get started. So we have the buildings there at cost, 902. So during the year, a storeroom which cost 40,000 was destroyed, and stock that was worth 12,000 was destroyed by fire. The new store was built by the firm's own workers. The cost of their labour was treated as a business expense, and materials costing 51 were taken from the firm stock. So they're currently sitting in the trading profit and loss, which is the wrong place for them. They should not be treated as an expense of the business. It should be treated as an increase in the asset buildings. So we take the cost of the salaries out of salaries and general expenses, so 19,000 from here. We take 51,000 from the stock, okay, because it was during the year. We take it from purchases, and we add the 19 and the 51 to the cost of the buildings then. So the insurance company has agreed to pay 52 in a claim for the loss. So 52,000 they haven't paid us yet, so that's going into current assets there. And now what we need to think, how much was the actual loss? So 52,000 is what the insurance company paid us, but the loss was 40 and 12. So look, the insurance company has coughed up 100% of what the loss was. So there's going to be no loss in the trading profit and loss there. So that's that. Now, then it says buildings to be depreciated by 2% of cost. So we have the buildings figure, which is 932,000. And we multiply that then by 2%, and that is 18,640 here, which I will add to my accumulated depreciation. So there was no depreciation to date. So I'm going to have the cost of my buildings 932 minus 18,640 depreciation charge for the year, and then 913,360 is then the net book value. So that's that one done. 2006, we have buildings 900,000, and then we have 45,000 accumulated depreciation. So buildings, note 6, a new warehouse was purchased during the year for 200,000 plus VAT 12.5%. The amount paid to the vendor was entered in the buildings account. No entry was made in the VAT account. And then note 7, provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 1.2 million on the 31st of the 12th, 2005. Okay, so we have the 900,000 and the 45,000 accumulated depreciation, and then we've got the VAT 4300, and they're both from the trial balance. So let's look at how the bookkeeper messed up here. Let's look at how it should have been recorded. So it should have been recorded 200,000 into the buildings account, and then the VAT 12.5%, which works out at 25,000, should have been recorded on the same side as the buildings there. What happened by mistake was that all of it went into the buildings account and nothing went into the VAT. So how do we fix it? We fix the buildings by putting 25,000 on the credit side of the buildings account and putting 25,000 on the debit side of the VAT account. And that's that. Now, so we'll take 25,000 from the buildings, and to the VAT we need to debit the VAT account, but this 43 is on the credit side, okay? So if we have 43 on the credit side, and then we'll have to minus 25, that's going to make the VAT a current asset. So we just move the VAT up into the current assets there, 4,300 minus 25. Then, when we've got that done, we have to provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 1.2 million on the 31st of 12th, 2005. So we have buildings here 875. So we have to do 875 by 2% is 17,500 euro depreciation, which we will add to the accumulated depreciation in the balance sheet. Then we're told to revalue it at 1.2 million, which we'll do here. And when we revalue, we'll have a revaluation reserve. So what is this 325 figure here? It's the difference between the new value 1.2 million and the cost, which is 875,000. Then we add the accumulated depreciation from the trial balance, and then we add the 17,500 depreciation charge for the year. So in total then we've got 387,500 there, and that's that one done. So 2005 buildings, note 5. During 2004, James Limited built an extension to the factory. The work was carried out by the company's own employees. The cost of their labour, €40,000, was included in factory wages. The cost of materials used, 18,000, is included in purchases. No entry was made in the books in respect of this extension. And then note 6, depreciation is provided on fixed assets as follows. factory buildings, 2% of cost at 31st of the 12th, 2004. Okay, so how is this going to look? So the work was carried out by the company's own employees. The cost of their labour, 40, is included in the manufacturing account here as factory wages, and the cost of materials used, 18, is included in purchases. So as you know, I've said before that the cost of building a fixed asset should be recorded up in the fixed asset account and not in the manufacturing account, which calculates what is the cost of manufacture overall for the goods that it manufactures and sells to its customers. So we will take 18,000 from the purchase of raw materials, we will take 40,000 from direct factory wages, and we will add those two amounts to the cost of the buildings and just record them where they actually need to be recorded. And that's that adjustment completely done. The next part of that then is saying depreciation is provided on fixed assets as follows. So factory buildings, 2% of cost. So as you know, the cost changed. So it increased by 58,000 there. So it's now up at 508,000. If we multiply that by 2%, that is 10,160 euro. And then we add that then to the accumulated depreciation, 10,160 there. And then that is literally it. You just tot it all up then, and that's the end of that. So the 2004 buildings adjustment was note 4. So it says buildings are to be depreciated at the rate of 2% of cost per annum. Land at cost was 130,000, and at the end of 2003 the company revalued the land and buildings at 880,000. Okay, so land and buildings at cost in the trial balance 780, and then the accumulated depreciation, land and buildings, 39,000. So this is what we have to do here. So here's the cost and here's the accumulated depreciation. So we're going to depreciate at a rate of 2% of cost. So 780 minus the land 130 multiplied by 2% is 13,000 euro depreciation for the year. We add that 13,000 up into our accumulated depreciation up here. We add it to the 39 we got in the trial balance, and then the next sentence says at the end of 2003 the company revalued the land and buildings to 880. So the cost is 880, accumulated depreciation 0, net book value 880. And then, as you know, when we revalue buildings we have to have revaluation reserve. So 880 is the new value minus the 780, the cost, is 100,000. So that's the difference between the new value and cost. Then we add back in the accumulated depreciation from the trial balance, and then we add back in the depreciation charge for the year. So overall we get 152 there, reval reserve. Okay, in 2003 we have buildings here 780, and then accumulated depreciation is the difference between the two. So buildings, number 6, a new warehouse was purchased during the year for 240,000 plus VAT 12.5%. The amount paid to the vendor was entered in the buildings account. No entry was made in the VAT account. And then note 7, provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 1.1 million on the 31st of the 12th, 2002. So 2 adjustments there. So let's get cracking. So to fix the VAT first. So the new warehouse was purchased for 240 plus VAT 12.5%. So this is how it should have went. So it was entered in the bank account correctly. If it wasn't, it would have told us so. So the 240 goes into the buildings there, and then the 30 VAT goes into the VAT account. So that's not what did happen though. What happened by mistake was that all of it went into the buildings account. So 270 into the buildings account there and nothing into the VAT. And to fix that then, we'll put 30,000 on the credit side of the buildings and then 30,000 on the debit side of the VAT. So let's see how that's going to look then. Up in the buildings account, we'll minus the 30, and the VAT was already on the credit side. If we are going to debit 30,000 there, we will move that up to the current assets. So 5500 minus 30 will go into the current assets there. And that is that. So then it says in note 7, provide for depreciation on buildings at the rate of 2% of cost per annum. It was decided to revalue the buildings at 1.1 million on the 31st of the 12th, 2002. So the buildings here are 980 minus 30 is 950 by 2 is 19,000 euro here, which we will add to our accumulated depreciation there. And then it says it was decided to revalue the buildings at 1.1 million on the 31st of the 12th 2002. So we simply put 1.1 million in the cost, nothing in accumulated depreciation, and then 1.1 million there. And as you know, whenever we revalue land and buildings, we're going to have a revaluation reserve. So it's 216,000 altogether. So what's it made up of? Well, it's made up of 150,000, which is the difference between the 1.1 million new value minus the 950 cost, and then we add back in the 47,000 euro and the 19,000 euro depreciation charge for the year. Then we have 2002. So note 4, buildings are to be depreciated at the rate of 2% of cost per annum, and land at cost was 350,000 euro. And at the end of 2001, the company revalued the land and buildings at 950,000. So we have our land and buildings cost here, 850, and our 76 accumulated depreciation there. And note 4, it says that buildings are to be depreciated at the rate of 2% of cost per annum, but we have to take account of the land. So we have 850 minus our 350 land is 500,000, multiplied by 2% is 10,000 euro buildings depreciation in the admin expenses. We add that 10,000 euro then to the tangible fixed assets up in the balance sheet. Then we're told at the end of 2001 they are revaluing their land and buildings at 950, so we have 950 in the cost, nothing in accumulated depreciation, and 950 in the net book value. As you know, when we revalue buildings, we're going to have a revaluation reserve. So it's 186 in this instance. So what is this made up of? So it's made up of 950 new value minus the cost 850. And then we add back in the accumulated depreciation 76,000, and we add back in then the 10,000 euro there. So 186 altogether. So that is the end of all of our buildings adjustments. So as you saw, there was many different ways that you could be asked to adjust something. So you've got the depreciation charge for the year, revaluation reserve. They put VAT into the buildings account by mistake and didn't put it into the VAT account. You have like a store or something destroyed by fire, and then you might have that they rebuild or build an extension or whatever. So they're all of the buildings adjustments. So as you saw as well, you know, there was only 1 year where nothing really came up. You just had to put the buildings figure from the trial balance into the books. But otherwise, you could have one adjustment, you could have two, and it wasn't uncommon to see years where 3 adjustments came up. So it's really important to get those buildings adjustments nailed.